Hey everyone. Today we'll be looking at the food services industry in totality and specifically quick service restaurants, which is called as QSRs. Uh, a few of them here are actually not QSRs, something like a Pizza Hut or a Barbecue Nation. They are termed under the casual dining restaurant space and not the QSR space. So we look at the food services industry in totality and then deep dive into what financial matrix to look at. Hope you are all hungry after this presentation and you have a good dinner today. Coming to the industry size, it's about 4.5 trillion rupees. It's about 2.5% of India's GDP, which is not small by any imagination. And it's expected to grow at around high single digits for the next 5 years. Uh, Out of that, the organized space, which is the chains plus the standalone organized restaurants, those are growing faster at about 15%. And we have seen the organized market share growing from about 18% in 2010 to about 40% in 2020. So it's expected to go even further up going ahead, as we have seen that the organized space is growing faster than the unorganized space. This industry has gone through three different phases. Domino's and McDonald's entered India sometime in late 90s, 96, 97. From then till 2010, they developed the QSR space. They developed the understanding of the consumers of this format and majorly tapped the metro cities. From 2010 to 16 was the phase when they started expanding into tier 2 and tier 3 towns, and they still are underpenetrated in that segment. From 2016-17 onwards, in the private equity era, we have seen some new formats coming up, like cloud kitchens, food aggregators having their own kitchens, etc. So we'll look at that as also going forward. Now, if you look at the global food services industries, so India is somewhere in between. So it's not that small when you compare it to the individual countries' GDP. So even if you look at a country like US, it's about 2.6% of GDP, the food services industry total, whereas in India it's about 2.1, 2.2%. So it's not that small. The problem is that the unorganized space in India is so big that these QSRs and the chain restaurants are underpenetrated. So if you look at the right hand column, uh, sorry, if you look at this column, so this is basically chain QSRs to the total food services industry. This, if you look at the India number, is only 4%. Whereas if you compare it with some of the even developing countries, Brazil is 9%, whereas US is at 40%. So this is where we could see some growth going forward. Now, if we compare global versus Indian, the QSR space, and we look at the revenue per store, so this is in million rupees. All the numbers are converted into rupees. So if you look at the McDonald's self-operated stores, which they operate some of them in US, that's the highest at about 253 or 25 crore per store. The franchise stores is about 17 crores or 172 million. Whereas if you look at others, Burger King, Popeye, KFC, etc., they are somewhere in the range of 80 to 85 million rupees. Taco Bell is a little higher at 107 and Chipotle is 140. So all these are global chains. Domino's is at 80. Uh, and then if you look at this bottom half, this is basically India. So Pizza Hut is at 46 million. Sorry, the Pizza Hut is also global, whereas from Jubilant, it's all the Indian restaurants start. So Jubilant is at 28. Westlife is basically McDonald's in south and west of India. This is 45 million. KFC India is about 45 million. Subway is a little lower, but it's into a completely different segment. Burger King is at about 41 million, and Pizza Hut India is about 27 million. Now, if we look at the annual spend per person in India, if you look at the top 8 cities, which has all the metro cities, chain market is about 2,800 rupees, whereas the unorganized market, which is the standalone organized restaurants that you visit, is about 5,000. Whereas the unorganized space, which is basically street vendors, the small thelas that we have, it's about 6,800 rupees. So even in metro cities, we are seeing that about 50% of the spends are still in the organized space. And in the next 21 cities, which are the tier 2 and 3 towns, there if you see majority of the spend is in the unorganized space, whereas chain markets and organized is very low. So this is the space which all the QSRs and casual dining restaurants are going to tap in the next 5 years. We have heard from a lot of QSRs and restaurants that over the years they have tried tapping into tier 2 and 3 towns, but the data actually doesn't say that. So if you look at the total food services industry, about 22% of the total sales comes from mega metros, which is Mumbai and Delhi. So only two cities contribute about 22%. The next six metros are at about 21%. Then the tier 1 and 2 towns are about 11%, and rest of India is about 47%. And if you just go into the chain restaurant space, two cities, which is Mumbai, Delhi, NCR region, they contribute about 42% of the chain restaurant sales. Whereas the next six cities or the next metros contribute about 45%. So basically, the top eight cities contribute 85-86% of the chain restaurant sales, whereas the balance is only less than 13-14%. So this is how underpenetrated we are in the tier 1 to 3 towns. Now coming to the demographics, so if you bifurcate the age-wise, 15 to 24, 25 to 34, and more than 35 years. And if you look at the eating out frequency per month, youngsters eat out about 2.5 times per month, whereas 25 to 34 is the earning bracket where they go out about twice a month, and more than 35 years is about 1.5 times a month. And the average spend in that outing, if you look at the 15 to 34 years bracket, is more or less the same, but the older you get, the more you spend or go to expensive restaurants, etc. Now going to the ordering frequency, which is ordering food at home, it's still less than 1 times even for the youngsters, even post the COVID growth that we have seen in the country. And the average spend is much lower than what you spend in a restaurant. So most of the QSR players are trying to tap this 15 to 34 years bracket, where they try and customize the menu for the youngsters, try and tap the sports events where these youngsters go out and watch those sports events. And healthier food options is what is the preferred options for these. But still, I would not think that they are providing healthy food yet. So we'll see going forward if they are able to do that. Now coming to the different formats that we have in the food services industry. First one is the fine dining restaurant, which is basically your full service restaurant where the waiter comes to your table, takes the order, and serves you food. It has a specific cuisine specialty and a very high standard of service. So this is basically where most of us go out for dinner. That industry is about 29 billion or 2,900 crore rupees. Second space is the casual dining restaurants, where it's a moderately priced food in an ambience oriented towards affordable dining. So a UDP kind of a restaurant or a Pizza Hut kind of a restaurant. So this is the biggest one, which is about 88,500 crores market. So and these include the standalone organized restaurants. This doesn't include the local street vendors. Third format is your pub, bars, club, lounges, which is growing very, very fast. And it's at about 17,600 crores. And they majorly serve alcohol and related beverages, and they include sports bars, etc. So just to give you examples, fine dining restaurants would be something like a Punjab Grill or a Papaya or something of that kind. Casual dining would be Pizza Hut, Barbecue Nation, etc. Pub bars would be BSC, the Beer Cafe, etc. Coming to quick service restaurants, that's about 33,600 crores. This segment basically focuses on the speed of service, affordability, and at the same time convenience. So they offer many convenience channels like drive-in, takeaway, delivery, etc. This would include your McDonald's, Subways, KFC, etc. Cafes is basically your coffee bars and parlors where they are casual restaurants and emphasize on serving beverages. So this would include your Starbucks, CCD, Costa Coffee, etc. This is about 9,700 crores. And last is the frozen desserts or the ice cream space where you have small outlets of ice cream brands and frozen yogurts, naturals kind of outlets. Now, coming to growth rates of each of these segments, so if you look at the blue bar, which is FY10 to 15, green bar is FY15 to 20, which is the last year, and this is the expected growth rate. This is by the source is Technopack Industry Report. So this is the expected growth rate. Even if you ignore the expected growth rate, if you see the past growth rate, QSR space and the CDR space are the fastest growing segments here. Pub bars are growing very fast, but at the same time, the base was very, very low in FY10. So that's why you see this higher growth. But if you look at the fine dining restaurants, that has been at a very low single digit kind of a growth rate. If you look at the market share of the organized space also, and if you look at the past FY10 to 15 and FY15 to 20, you can see that the QSRs have been gaining market share from 33% to 45%, whereas the cafes, fine dining restaurants have been losing market share. This is based on the spend that the consumer makes in a restaurant or a cafe. Now let's come to the different type of franchise agreements that we have in this space. So one is a master franchise agreement where the brand owner spends some time with the master franchisee here in India, and they help them with the branding, the pre-operative expenses, or developing the supply chain, finding some stores and real estate, etc. Whereas in return they charge royalty for it. The second is company owned plus franchise, where the only difference between the first and the second is that they have a subsidiary in India which handles the master franchisee here. So they have an office set up in India which takes care of this. The examples of this are Jumbo King, Pizza Hut, etc. 100% company owned is basically doing your own capex that is very, very capital intensive, and this was done by CCD, and we can see what happened with CCD. Last is the joint venture where the international brand owner has a JV with the Indian partner. This is done by Burger King in India, where it's owned by the Burger King brand owner, and at the same time they have a partner. They have listing here, and they have Everstone Capital also as one of their partners. Now, if we look at the partners of the global QSRs in India, for Domino's, obviously we have a Jubilant Foodworks, which has the master franchisee agreement. The royalty rate here is somewhere around 3%, which is the lowest in the industry. Second is McDonald's. So North and East earlier was with Mr. Sanjay Bakshi, Vikram Bakshi, sorry, and then due to the disputes, they had to cancel the agreement, and then it was sold to Agarwal Group. South and West is the master franchisee agreement is held with Westlife Development, which is a listed company. The royalty here right now is 4%, but it is expected to go up to 8% in tranches over the next 3 to 4 years. Pizza Hut, which is owned by Yum Brands, they have two franchisees here, Devyani International and Sapphire Foods, both of which are listed now. The royalty here is somewhere around 7 to 8%. Similar for KFC because it's owned by the same company. Subway has a had a different business model where they had different franchisee partners for each of the outlets. So they didn't have a master franchisee agreement, and they used to charge royalty of about 7 to 8%. But recently, we have seen the announcement where they have appointed Everstone Group as the master franchisee for India and a few neighboring countries, Sri Lanka, etc. So we could see some change in the financials of this QSR. Burger King is owned by Restaurant Brand International, and it's a JV, as I said earlier. The royalty here is 4 to 5%, and the JV agreement is signed in such a way where it gives flexibility to the JV partner in India to fix the menu pricing, find some real estate, and customize the menu as per the tastes of the Indian consumers. And last is Chili's. So we have very few outlets right now, but it's owned by Brinker International, and they have two master franchisee or a regional franchisee agreements, one in North and East, and second in South and West. Now, the growth drivers of the industry are very, very well known. So, I don't want to go too deep into this because these are very well known. Where we have seen income levels rising, we have seen nuclearization of families, working women, so or more ordering of food from outside, etc. At the same time, we have seen high convenience from food aggregators, etc., where people order very easily. We have seen higher internet penetration, which led to the food delivery and food tech businesses. So these are the growth drivers for the industry, which are very, very well known. But if you look at the hard data, it's not fructified into the numbers. So these are the same store sales growth numbers over the years, over the last 10 years for uh, Jubilant Foodworks, Westlight Development. Yum is basically your KFC plus Pizza Hut plus Costa, and this would include both your franchisees, so Devyani plus Sapphire. And last is the Burger King. Data for Burger King is limited because it was recently listed. But if you look at the SSG numbers, it has been all over the place. Some of it is also because they are expanding very fast, and hence the newer stores are loss making, or they are less revenue earning in the initial years. But yes, it's been all over the place. Some or the other reason, if you see in FY 15-16, they would give the reason of demonetization, then the GST, then COVID, etc. So all these reasons have led to this number. Now, coming to the impact of COVID and the last 2 years, so we have seen many restaurants close. We have seen about 30 to 40% restaurants across India getting shut. These are standalone restaurants. You have higher proportion of delivery orders because everyone was used to ordering at home. You can clearly see a move towards branded players, because if you see the organized space, that is growing much faster than the unorganized space. At the same time, there's some focus on safety, hygiene, etc. in the last couple of years. Also, we have seen, because of the growth that they have seen, they have very aggressive expansion plans in the coming years. So most of the players, if you hear the commentary, they have very, very aggressive expansion plans in the coming years. And also, because of the closure of some of the restaurants, there is increased supply of the real estate in the market also. Now, if you look at the number of outlets of each of the QSRs which is there in India, so I have included a few Indian owned brands also. So Jumbo King, La Pinos, Haldiram, Bikaner Wala, etc. So if you look at the core offerings and the outlets, Domino's is by far the has the highest number of outlets at about 1350, followed by Subway, which has about 550. McDonald's is 480. But if you look at the bifurcation, North and East was something which was struggling because of the franchisee partner. Otherwise, this would have been much higher. KFC is at about 450 outlets. Wow Momo is about 300 outlets. Burger King about 260. Jumbo King 130. La Pinos is something which has been expanding majorly into tier 1, 2 towns, and this is what we have seen in the past. Haldirams and Bikanerwala have started out majorly in mega metros, but slowly they will start expanding into other cities as well. Smoking Joe's has about 50 outlets, and we have seen Taco Bell also entering into India, which has about 57 outlets. So these are the major players which have entered India, or some of the brands are based in India. Now, if we look at the market share by outlet count, Domino's has about 19% market share, whereas Subway is at about 8%, McDonald's at 7, KFC at 6, Burger King at 4. So, if you look at the bifurcation, it's very very fragmented, with the top two three players also contributing only less than 30% of the outlets. If you look at the market share by revenue, Domino's is at about 21%, McDonald's is at 11%, KFC is at 10%, Subway 6, Burger King at 5. So again, here you see Domino's is dominating because of the initial growth that they had seen, and in the recent years also because of the value program, that value menu they have launched. They have seen higher growth and higher market share. Now, coming to the market share by cuisines, if you look at the cuisine, burgers and sandwiches is by far the largest segment with about 31% market share, whereas pizzas is the second largest with about 27%. Chicken is something which every player is now trying to enter into. KFC was the first one, but now we have seen McDonald's launching chicken menu in the south, and then gradually they will bring it to the west as well. And Domino's or Jubilant has a tie-up with Popeyes now. So we could see some growth in this segment also. And the Indian ethnic is basically Haldiram's, Bikaner wala, etc.
Recording in progress.
Zoom was down. So let's come to the costs now. So what are the major store level costs that the each of these QSR has? So one is obviously the employee costs, where out of the four or five major brands that we have, Domino's has the highest cost. The reason being that they have their own delivery fleet, so that inflates their employee count and the cost. Second is lease rentals. So McDonald's or Westlife is the best in this business, where they know the exact locations, and at the same time, while paying rent, also they are the best, given that they have long-term rentals with escalation clauses over 5-year period. Ad spends, if you look at the ad spends, highest is for Burger King, being the late entrant. They have had to spend a lot on ad spends. And last is the royalty. So we'll look at the royalty chart in the next, which I have discussed in the initial slides. But Subway and McDonald's right now is at 4%, but it will eventually go up to 8%. Pizza Hut and KFC are at 6-7%, whereas Costa Coffee is at 6%. Burger King is at 5%, and Domino's is the lowest at 3%. Sorry.
What you are charging the store,
Right.
what the brand is charging the store. So are you referring to that, or what they are paying to the US?
What the brand is charging to the master franchisee here.
Okay, so the global brand charging
Global
the
brand is
so
charging.
these are
the costs for the Indian franchisee partners.
Okay, thanks.
Another major cost is obviously the raw materials, and hence supply chain management is something which is very very important. So most of the brands or the international brands have a fixed tie-up with partners in India, and you have to purchase raw materials from those partners only. Some owners like Burger King, since it is a JV, they have given flexibility to them to choose their own supply chain partners. If you look, just to give you an example, so these are the partners for Burger King. So for patties and fries, they have Hyphen Foods. For distribution, they have Coldex. Sauces they take from Viva. Chicken is from Wenky's. Breads is from Mrs. Bector's, which is again a listed company. Beverages, they have a tie-up with PepsiCo. Cheese they buy from Dynamix. So Dynamix is a player which provides dairy products to almost all the QSRs. Whereas if you look at the McDonald's supply chain, sauces is something which they buy from Mrs. Bector, sauces and breads both. Distribution partner, they have Radhakrishna Foodland, which is a India-based company only. Whereas Venky's is a major provider of chicken to both Burger King and KFC. Okay. Okay. Not sure about that.
Started by Radhakrishna was started by Indian entrepreneur, but taken over by Sodexo, which is a French company.
Okay. Now let's look at the per store economics across which is highest for Chili's, Barbecue Nation, but again those are casual dining restaurants. Whereas in the QSR space, if we see McDonald's and KFC are highest. McDonald's is about 77,500. Burger is about 32,500, and sorry, Subway is at about 32,500, and Burger King is at about 1,15,000. And if we look at the annual sales per store, which basically is again highest for McDonald's and KFC. And if you look at the gross margins, it's highest for Domino's, followed by Pizza Hut, and then the burger and the sandwiches companies. Now, if you look at the store EBITDA margin, it's the highest for Subway, Domino's, followed by Subway, and then Chili's, Barbecue Nation, etc. Whereas if we look at the capex per store, it's the lowest for Subway, and this is where Subway has a major advantage. So if you look at the next slide, I'll tell you. So this is, if you look at the store level ROCE, it's the highest for Subway. It's about 42%. That's because of the very low capex that it has. Whereas Domino's is at 24%, Barbecue Nation is at 30%, Chili's is at 23%, etc. So the major reason being that the capex per store of Subway is very, very low. Whereas if you compare the EBITDA margins, they are more or less similar to Domino's. Now, what can be the operating leverage kickers for this business? So one is adding complementary products which improve your margins. For example, McCafe. So for McDonald's, McCafe was a major contributor to the margins over the past 4 or 5 years. That's because they offer beverages. Beverages are inherently highly priced in India, abroad also, and they have very high gross margins. So price points are upwards of 100, and the gross margins are somewhere around 75 to 80%. So this is where they have been gaining the margins, and at the same time, this helps in increasing the volumes and the same store sales growth for each of these stores. For this, they have to do a capex of only 25 to 30 lakhs per store, and what this basically does is it basically gives them audience in between the meals. So basically you have customers in the morning also, afternoon also, for the beverages, and this improves the capacity utilization, and inherently your ROC improves. So this is the format which is now being copied by Burger King also. Burger King has also launched Burger King Cafe, BK Cafe. So going forward, we'll see that also. Second operating leverage kicker is your convenience channels, which is basically drive-in, takeaway, etc. So if you look at the history over the past 3 years also, if you see, dine-in has, again, I have not taken FY21 because of COVID. Otherwise, the delivery volumes would have shot through the roof. So if you look at the dine-in in the FY18 to 20 period, also that has decreased from 42 to 35% for Domino's. Whereas the own app is about 25% now, and takeaway is about 25%. Aggregator is at about 15%. So basically 65% of their revenues comes from delivery or the convenience channels. McDonald's traditionally had been a dine-in place, but over the years they have tried to focus on it, and with the food aggregators at the same time having their own app, they have tried to grow this channel, and plus the drive-in channel, which has been working really well for them. So right now, 45% of their sales comes from these convenience channels. Pizza Hut is someone who had traditionally struggled because they were focused more on the dine-in. They didn't focus too much on delivery, which Domino's focused on, and that's why you could see Pizza Hut not growing in India. KFC is still 60% dine-in, whereas the balance convenience channels are 40%. So this basically this doesn't require any additional space for them. This can be a operating leverage kicker. Third is the technology. So Domino's calls itself a technology company which is selling pizzas. So building your own app, having self kiosks to enter your orders, etc. It reduces your employee cost, and these technologies can reduce your cost, and it can in turn help your margins to grow over a period of time. Now let's move to the new models which have come up over the years. So one is cloud kitchens. This basically is a dark kitchen or a dark warehouse kind of a thing where you don't have a front, you don't know what's happening inside. They only have a kitchen and then they give delivery to the customers. So it helps in exploring different brands and cuisines because you don't have any upfront cost. It's mainly a delivery only business, and it has flexibility to be an all meal business because you don't have a front end and you don't have costs. You can be open from 7 a.m. in the morning till late in the night. It has no location boundaries, the only constraint being the logistics and the delivery. And since you don't have any supervision cost or a branch manager or a cash a manager, it saves in supervision costs or the higher cost employees. And lastly, they have started a new segment where they provide restaurant as a service. So they have tied up, for example, Rebel Foods is one of the top cloud kitchens in India, and they have tied up with a brand called Wendy's to develop cloud kitchens in India. So they are going to develop about 200 cloud kitchens in India for Wendy's. So, just to give you a background of Rebel Foods, so Rebel Foods is now a unicorn, and they have brands like Behro's Biryani, or it originally started off as Fasos. It was named Fasos. Then they converted those Fasos stores into cloud kitchens, and then they started the other brands like Behro's Biryani, Oven Story Pizza, etc. So they have about 450 kitchens across 10 countries now. They are present globally also, and they have about 10 to 15 brands now. One more business which they have recently started is that in COVID, due to shutdown of many stores, they have started providing other brands to operate from their cloud kitchens. So they in turn lease it out to other brands. So that is also one of the segments that they have recently started. Other is food aggregators having their own brands and having their own cloud kitchens. So Swiggy, for example, has their own cloud kitchens. What they do is they get data from the consumers as to what time they are consuming, what cuisine they are consuming, and where are the gaps. For example, say in town area, there is no one who is a biryani player, then they would probably have a cloud kitchen in town area serving only biryani. So because of the data analytics and the data that they have, they can build this over a period of time. It's basically a food aggregator platform is a customer acquisition platform, but then they in turn sell them some other cuisines as well. So what are the key competitive advantages that any QSR can have in this business? One is cultural relevance and adaptability. We have seen many international brands come to India, but they have struggled because they have not adapted to the Indian taste or the Indian culture, and that's why they have had to shut their shop. Menu relevance and innovation. So, for example, one is having separate veg and non-veg kitchens. Second is no beef or pork in India, given that the culture in India doesn't allow that. Then the unit economics, supply chain, operating leverage. So these are the major, I would say, competitive advantages that any QSR can have. Another competitive advantage is employee training. So McDonald's has become very, very famous in this. They have a university, hamburger university, where they train high quality restaurant managers, mid managers, owner operators, etc. More than 5,000 students attend this university every year. Until now, they have trained about 275,000 students who have graduated with a degree of hamburgerology. And right now, they have about 9 campuses across the globe. So Chicago, Tokyo, Sydney, Munich, Sao Paulo, Shanghai, Moscow, etc. Sometimes it's even tough to get admission here, so as tough as Harvard. If you look at the acceptance ratios of admissions, it's much lower than Harvard also. Now, just to digress a bit, so let's look at the business models of the brand owners rather than the franchisees. So each of the brand owners has a different business model. For example, Domino's, majority of their revenues is coming from providing supply chain to its franchisee partners. Whereas McDonald's calls it a real estate company. They are basically owning the land and then leasing it to the franchisee. So every brand owner has its own business model, and some of the legacy stores in especially in US are still operated by the brand owners, but a majority, I would say 90% plus of these stores have been franchised by the majority brand owners, and most of their time and expertise is spent on marketing, branding, menu innovation, and helping the franchisee partners. So this is a movie on the founder of McDonald's. I would say the second founder of McDonald's. The original McDonald brothers business was acquired by Ray Kroc, and he was the one who was selling milkshake machine to the McDonald brothers. And from there, he thought that the business was very great, and he acquired the business, and then he moved on to becoming a real estate company where he owned the land and then gave it out on rent to the franchisees. There's a book also, Grinding It Out, and there's a documentary, The Founder, on this if you want to watch it. So McDonald's is a real estate company. If you look at the total assets in USD billion, they are at about 40 to 50 billion dollars. And if you count this figure, then it's the seventh largest real estate company in the world. So that's how big their real estate business is, and that's how they really make money. So royalty and initial franchisee fees, obviously they take, but the majority of the revenues come from the leases that they have. Coming to India, again, the listed players are increasing. Earlier, 5 years back, you would totally depend on Jubilant to give you the data on the industry. But since then, we have seen Westlife Development getting merged with Hardcastle getting merged with Westlife, and then Westlife getting listed. Recently, we have seen Devyani and Sapphire Foods getting listed. Burger King also getting listed last year. Barbecue Nation is something which is in the transformation phase, where they started off as a casual dining restaurant, but they are slowly trying to transform themselves into somewhat of a cozy QSR, where they have a value menu. At the same time, they are focusing on delivery and weekday menu, where they provide food to the office going people at a very cheap rate. So this is their business model. Lastly, coming to the valuations. So again, I don't want to focus too much on this because none of the companies are profitable except for Jubilant. So there are 2 or 3 ways to value it. One is obviously DCF, where you project cash flows over the next 10-15 years and then lay out your own assumptions as to what will be the SSG, etc. Second is you go by EV to sales or EV to EBITDA multiple. Because you don't have earnings, this cannot be used. The right two columns are the brand owners, which are Domino's and McDonald's. So one is EV to sales. If you compare across the companies, Jubilant is 10 times, Devyani is 16, Westlife is 8, Burger King is 8 times, Barbecue. So more or less they are very very similar, except for Devyani, which was recently listed. If you look at the EV to EBITDA multiple, again Burger King is negative on EBITDA as well, given the growth, given the way they are growing. But apart from that, if you look at the multiples, again they don't make any sense. So it's very very difficult to value these companies. The only way you can do it is through DCF. Lastly, even though they say that they serve healthy food, I would like to warn you. So these are the two documentaries which will put you off the QSR food. So this was basically an experiment by Morgan Spurlock, who has made this documentary. So what the experiment he did was, in 1 month he ate only McDonald's food 3 times a day, and the challenge was that he would eat everything that is there on the menu. So after about 30 days, he had put on about 11 kgs. He had consumed about 5,000 kilocalories. He had gained mass weight by 13%, and it took about 14 months for him to reduce the weight that he had gained during this 1 month, and that too through vegan diet that his girlfriend offered him. So this is how unhealthy the food is. So this will put you off. So you can replace your buns with your whole wheat buns, but that basically only reduces your calories. It doesn't become healthy food. So these are the sources which I have used. Majorly, all of them are public information. Technopack industry report is the major source which I have used, and then the RHP's annual reports, investor presentations, etc. Happy to take any questions.
Yeah, so I had two questions. Probably, like I think there might be risks. So I would love to know your opinion. The first one is, like we know the entire trend is going towards healthier foods, not health foods per se. So, like I know this has happened in some Scandinavian countries, where like there's been a restriction on the amount of sugar, calories, and trans fat, all these things. So, if basically something like that were to ever come, these people obviously sell completely junk food. So, love to know your opinion on that. And secondly, where would you put in snacking as a category? So, where I guess what I'm trying to say is that if you think about out of home consumption, like your non kitchen consumption, these snacking companies, healthier snacking companies, their sales have really grown, and a lot of these like D2C brands, they are really growing and on a relatively decent base. So will that eat into this, because both of them are out of your kitchen consumption? So yeah.
So to answer your second question first, so definitely snacking companies are a competition to these QSRs. But at the same time, if you want to have light food, you will probably have a snack from say a wafer packet or something. But if you want to have a meal which is filling, then you will probably go for.
I'm actually talking about like meal replacing snacks. Like Epigamia, for example, they do these yogurts, and then you have these energy bars and all of that shakes and.
So there will be space for everyone to grow. So right now the market size is organized market size is itself growing. So as long as they are able to take market share from the local street vendors, the local players, then there will be space for everyone. So that is one thing. And on your risk part, so I don't know whether the regulator will put any restrictions or not, but definitely that is a risk which, so again, in every con call or commentary from the management, they will say that they replaced this raw material in the dip or the sauce, and that's how they reduced this much calories, etc. So they'll try and say everything, but I don't know whether they will actually come up with a regulation on it, and they'll how it will be followed in India. That I don't know.
Hi. So while increasing store expansion and improving gross and EBITDA margins may be some of the metrics to evaluate these QSR chains, what are the couple of most important or determining factors, in your opinion, would be to kind of evaluate a QSR?
So store level metrics, as I said, so what are the annual sales per day, how much margins they are able to make, and what is the contribution of beverages in the portfolio. So basically, the more they sell from one store, the more they will be able to, apart from the expansion, of course, the same store sales growth is something which really helps. So beyond a point, if a store matures, obviously the say SSG also plateaus to an extent, and then you have to open a new store in the nearby area to grow. So yeah, these are the major metrics that I would look at. So it's been up and down, but yeah, broadly it's been, if a mature store would be somewhere around that range, 5 and 7%. Yeah.
Hi, a fantastic presentation.
Thank you.
You said in your presentation that Domino's is one of the players that is having their own delivery system. So, what is the motive to keep that? So, what is their gain from that?
Sure. So Jubilant says that making pizza and delivering pizza are equally important. So delivering it hot will only increase the taste for the consumer, and that's why they want to deliver it themselves. Another thing is, so just to give you some numbers, traditional restaurant pays food aggregators somewhere around 18 to 20%, whereas these cloud kitchens are on the little higher side, say 23, 24%, whereas Domino's or Jubilant pays only 7% of their. So that's where, so what they intend to do is, by saving that 10, 11, 12%, they try and pay the employees and then get it delivered. So yeah, that's their
Right.
business model.
Thank you.
Yeah. Anyone on Zoom having a question? Yeah.
Hello. Yeah, hi.
Yeah. Hi.
So I just wanted to ask, like, how do these players, like the bigger players and the smaller players, how do they balance it out on the marketing part, as in the discounts that they provide on their own platforms versus the ones that they provide on the aggregators platforms? So how do they balance it on? What is the viability of that in terms of the bigger players and the smaller players?
So majority of the discounts that are there on the aggregator platforms are given by the aggregator themselves, whereas the discounts which are there on their own apps is handled by them. And coming to the marketing and branding, so on the branding of the say the QSR or say McDonald's or a Domino's, some of it is spent by the brand owner, some of it is spent by the franchisee here, and at the same time local marketing is done by the franchisee owner. So a franchisee owner in town would have the billboards spent by him and not the Westlife development. Yeah.
Hi, nice presentation.
Thank you.
Jubilant Food recently have ventured into Chinese and some, they have started their own stores. So, any thoughts like, they are regret, they should not concentrate on their pizza business model and, getting into the unrelated business. And it's a Chinese, their own brand, am I right? They are creating by their own.
Yes. So they feel that Chinese, so they have their own biryani brand, plus they have their own Chinese brand, and now they have a tie-up with Popeyes for the chicken business. So for the Chinese and biryani brands, what their intention is that these are the two biggest cuisines which are there, which is not tapped by the organized market. So that's where they feel that if any organized player comes in and does well in this segment, they would be able to gain market share, and it would give them a first mover advantage. So they have started off slowly. They have started off in one city, two cities, and then as and when it scales up, if they get a good response, they'll start scaling it up. So they have a biryani brand, Ekdam Biryani, and they have a Chinese brand, Hong's Kitchen. Yeah. So the question is, does Zomato also have dark kitchens, and if so, at what stage they are? Uh, I haven't heard from the Zomato management that they are looking at dark kitchens at this moment. Swiggy already has it, so I don't think Zomato has any intentions of. They are focusing on the 10-minute delivery for now.
Yeah, sorry. Just to add to that question, so Zomato in the past has said that they don't want to get into any business which competes directly with the restaurants. So that's something that they stated. But again, with this 10-minute delivery, there is a good chance that that could happen because they've said that they would need some inventory in that. So not too many details are out regarding the 10-minute delivery, but that's something we need to wait and watch.
So, couple of questions. First is, I think you mentioned that the in Jubilant Food the royalty is going to go up from 3% to
No,
no.
Westlife, I said it's going to go.
Oh, Westlife.
Jubilant is at 3%. Only.
They'll stay that. Okay. The second question is like there is a few years ago, it's probably 15, 20 years ago, when McDonald's entered Philippines, there was a local chain called Jollibee, and Jollibee gave them very tough competition. They wherever McDonald's opened a store, in front of that they opened a store, and they did so well that they got worldwide coverage. That they actually beat McDonald's that time. So the question is, who in India is trying to do that? Bringing Indian cuisines and developing QSR. Do you see any worthwhile?
So Jumbo King
company?
was one player which tried to do that. To some extent, they succeeded in the metros, especially in Maharashtra, because vada pav was a staple food for the Maharashtrians. But beyond Maharashtra, they have struggled. So that was one of the things. Other than that, Haldirams, Bikaner Wala, etc. have tried, but they are more into the snacking space. So I don't think there's any. La Pino's is one pizza brand which has given some competition to Domino's and Pizza Hut, but again, not meaningful.
So one observation which I have seen, I have lived in US also. There is like India mein ek chain aaya tha, only parathas, and you will find everything there. You will get biryani and dahi vada and everything. So lot of Indian guys don't focus on a particular cuisine, and they don't have their the SKUs controlled. Like even Bikaner wala, they have hundreds of products, right? So the supply chain efficiency and focus and brand recognition, that get blurred if you do too many things.
Correct. So if you
So
want to
there's
scale,
nobody-
definitely focus is very
Focus
important.
is important. Yeah. So you haven't seen anybody amongst startups coming up with
So
this kind
Rebel
of.
Foods is someone who has done well, but again, it's in a different segment. It's
So
in the
Rebel
club
also,
space.
I heard they started with Faso, then Biryani, then now they've got 10 brands.
But all of them
So-
are growing. So all of them are doing well. So their business model is completely different from this QSR space, but it's doing really
But they
well.
don't have that kind of a brand recall and brand, strength of the brand.
Behro's Biryani is very famous. So if you search on Zomato, Swiggy, you will get that upfront.
Yeah. Okay. Thanks.
So while Devyani and Sapphire both pay about 6.5% as marketing and advertising spends to the parent on top of the royalty that they pay of 6%, does Burger King also have any similar kind of mandate from the parent? I mean, I do know they pay 5% as royalty, but do they also have to pay any certain fixed percentage as marketing and ad spends?
I don't think so. So some local marketing is done by them, but nothing as a percentage of sales that they have to.
Okay, because both Sapphire and Devyani are paying about
That is specific to
6.5%.
Yum brand. Not
Okay.
to
So that's an add-on, right? Which
Yes.
kind of will impact or hurt their bottom line.
Correct.
So we were talking about this McCafe. So my daughter is quite frequent, but what we have seen is that the total percentage of spent on McCafe is far less, maybe because of lack of awareness. While the pricing as compared to CCD or any other people are much lower and the quality is fairly good, what is the reason for their McCafe not getting a...
So it's done really well. So right now, if you see the revenue bifurcation, about 20-25% of their sales comes from McCafes. So
Is it?
yeah, in 5 years, if something is contributing so much to the revenue, they have done well. So, and it's a complementary product. So you would buy a burger and a coffee. So obviously the coffee would cost you more than the burger, but you would probably have a drink along with the burger.
Yeah, but then that coffee is still cheaper than the other
Yes,
coffees
it's
that are
about
available.
20-25% cheaper than Starbucks or
Yeah.
a Costa.
Yeah.
Yeah. Yeah. Okay, great. Thanks. We'll wind up then.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.